Welcome to today's RTMA for August 9th. I'll be doing the fundamental and technical analysis today for this week. So let's jump right on in. Looking at the Canadian economy, the consumer price index grew by 3.1% over the last 12 months in June versus 3.6% year over year in May. Excluding gasoline, CPI rose by 2.1% year over year. The monthly CPI rose by 0.3% in June, down from 0.5% in May, while on a seasonally adjusted monthly basis, CPI rose by 0.1% in June. Gasoline prices have risen at a slower annual pace, as prices in May rose by 43.4% and grew by only 32.2% in June. The slower price growth in June can be traced to rising prices in June 2020, as prices were able to rebound as the economy started to reopen after the first wave of COVID. In June 2020, gasoline prices rose 10.5% month over month as demand began to rise. Shelter costs rose by 4.4% over the last 12 months, driven by the sustained rise in the homeowners replacement cost index, which grew by 13% in June. Prices for new homes continue to be impacted by the shifting consumer preferences, combined with higher building costs compared to the same time last year. Commissions and legal fees on real estate grew by 12% year over year, while the mortgage interest cost index fell by 8.6% in the last 12 months, with its strongest decline on record. Interest rates do remain at historic lows. Fresh and/or frozen beef prices fell by 11.1% compared to last year, when beef prices jumped due to falling supply, as many plants were either closed or had limited production due to COVID. The prices for fresh and/or frozen chicken jumped 10.6% year over year, as prices were low in June of 2020. The fresh vegetable index trended lower again in June, falling by 7.5% year over year. It was dragged lower due to falling prices for tomatoes, which have fallen by 30%, and potatoes, which have fallen 7.7%. The declines occurred amid increased supply due to favorable weather conditions in growing regions. The fall in prices for tomatoes was partly driven by a base year effect, as prices jumped 16% month over month in June of 2020. This again was due to lower supply. Among the provinces, the price growth in Saskatchewan slowed the most year over year in June, as inflation only grew by 1.8% compared to May of 2.7%. Most of the slowdown resulted in lower prices for passenger vehicle insurance premiums. Over the last 12 months, prices rose at a slower pace in June than in May for every single province. Here you can see annual inflation, 3.4%, 3.6%, 3.1% over the last 3 months. We are not used to seeing these kind of numbers, but the Bank of Canada is okay with inflation running a little hot because it has been below the 2% mark for quite some time. So they are going to let the inflation run hot as long as the economy continues to grow. And you can see here month over month, not a big deal, 0.5% for the 4 months out of 5, and then 0.3%. So while inflation on an overall basis is growing higher, most of it is due to gasoline prices, which of course have rebounded due to demand as the economy has reopened. But again, the Bank of Canada is totally okay with the economy running hot, or inflation running hot, as long as the economy continues to grow. One of the main drivers of economic growth here has been the building permit sector, and the total value of building permits rose by 6.9% to $10.3 billion in June, as several provinces contributed to the gain. This was led by Ontario, which jumped 22.7%. Construction intentions in the residential sector were up 9.1%, while the non-residential sector advanced 2.2%. On a seasonally adjusted basis, on a constant dollar basis, building permits increased 5.2% to $7.2 billion. High-value permits for new apartment buildings in Toronto and Hamilton helped to push multifamily permits up 13.5% to $3.7 billion nationally. Provincially, Ontario led the way as permits rebounded by 67.8%, hitting $1.8 billion. Quebec reported the largest decline, falling almost 30% as it pulled back from record highs achieved in May. Construction intentions for single-family dwellings increased by 4.7% to $3.4 billion, as 7 provinces generated gains, led by Ontario and Alberta. Residential building permits increased by 9.1% to $7.2 billion, following 2 months of declining construction intentions. Construction intentions for non-residential permits were up 2.2%, hitting $3.1 billion, as gains were created in 8 provinces, led by Alberta, which hit 32.7% growth. The value of commercial permits rose 7.4% to $1.7 billion due to major projects in Vaughan and in Lethbridge, but these gains were partially offset by a 92.5% decline in Newfoundland and Labrador. Industrial permits jumped 2.3% to $526 million, with 6 provinces generating gains, led by Ontario, which grew by 37.8%, while Quebec reported the largest decline of 32.9%. Institutional permits was the only sector which saw a decline, as it fell by 6.7% to $871 million, as the 37.7% decline in Ontario pulled the national average lower. Quebec surged to 38.4%, or $359 million, as several permits issued for alternative care and senior citizen residences coincided with an initiative from the provincial government. They were looking to add more beds to the system, so we saw an increase in these types of buildings. So throughout the second quarter, total building permits declined 1.7% to $31 billion, and despite the decline in value, the building permits remained the second highest on record, and is 38.5% higher than the same time last year. Second quarter residential permits fell by 4.2% to $21.4 billion. Both single and multifamily permits dropped across 7 provinces. Construction intentions for the non-residential sector rose by 4.5% to $9.6 billion. And while second quarter values outperformed first quarter values of 2020, they still remained below 2019 levels. So when we're looking at, why are we talking about building permits? A, it's one of the things that have helped push economic growth higher. B, inputs into the construction sector is something that is going to impact the stock market, right? Because there's companies that have to provide inputs such as lumber. So West Fraser Group would be a good one. Labor remains tight, as we'll talk about in a bit. And so it has an impact on economic growth moving forward. So understanding where the growth is occurring, Ontario, which has one of the major populations here in Canada, Quebec, we're seeing a decline overall, which is not good because it is a second populous province. BC is declining as well, but overall, we're seeing growth in the residential and non-residential side. So economic growth is occurring in this part of the economy, which is questionable how sustainable it's going to be, but with interest rates being so low, borrowing is continuing to go up as the cost of borrowing, as we saw, continues to decline. So people are going to look to take advantage of that, refinance their mortgages maybe. I know my 5-year came up and we got offered a really good rate, so obviously I took the lower rate on a fixed term, but it's because interest rates are so low and banks are looking to lock in people. So building permits moving in the right direction. Looking at trade, which is supposed to be one of the pillars of economic growth here in Canada, we see a sharp increase in exports have pushed the merchandise trade balance into a surplus position after posting a loss in the previous month. So May was negative $1.6 billion. June was up to $3.2 billion in growth. So that is quite a strong gain. Exports rose 8.7%, up to $53.8 billion compared to the previous month. And excluding the fluctuations of 2020, the increase in value for this month was the largest on record. Exports were higher in 9 of 11 product categories, and non-energy exports actually rose 5.5%. In real or volume terms, total exports grew by 7%. Now, exports of energy products jumped 22.9% to $11.3 billion for the highest level since May of 2019. Now, this gain of $2.1 billion accounts for almost half of the total gain in exports. And this was mainly attributed to the 25.7% increase in crude oil exports. Prices of crude did increase throughout the month, but the gain in exports was actually tied to higher export volumes, which reversed the trend of slower production in April and in May. Exports of refined petroleum products grew by 37%. Natural gas jumped by 23%. So we saw a lot of growth in energy exports as the economy come back onto growing terms, both in Canada and the United States. Demand is starting to rebound, and producers are saying, hey, let's take advantage of this. Exports of motor vehicles and parts rose by 14.9% in June, following monthly declines related to shutdowns caused by supply chain issues. As we saw, exports of passenger cars and light trucks jumped by 24.6%. Work stoppages at Canadian assembly plants in June were less severe than in April and in May. Exports of metal and non-metallic mineral products increased by 12.7%. This hit a record of $6.7 billion as exports of unwrought gold, silver, and platinum group metals contributed most of the gain. This sector was up 23.2% with higher exports to Hong Kong and to the United Kingdom. Total imports decreased by 1%, falling to $50.5 billion. Imports were down in 7 of 11 subsectors, and in real or volume terms, they fell by 2.2% in June. Imports of consumer goods dropped 3.7% and contributed the most to the overall decline in June. After a 16.5% skyrocketing jump in May, imports of miscellaneous goods and supplies fell almost 19% in June, posting the largest decline in the sector. The decline in imports was partially offset by higher imports of pharmaceutical and medicinal products, which jumped 24.5%, mainly due to influenza pharmaceutical imports, and this has reached a record high in June. Imports of motor vehicles and parts fell by almost 4% after a 7.7% increase in May. The global auto industry continues to be dealing with a current significant shortage of parts, and this has slowed down the imports of passenger trucks and cars. On a more volatile basis, the imports of aircraft and transportation equipment rose 28% as aircraft imports jumped $458 million due to 5 new commercial airliners and 3 cargo aircraft being imported in June. Exports to the United States rose by 8.2% to a record high of $39.7 billion in June, again due to higher crude oil and passenger cars and trucks exports. Imports from the United States increased by 1.9%. This helped widen the trade surplus from $5.9 billion in May to $8.3 billion in June, for the widest surplus since August of 2008. Exports to countries aside from the United States increased by 10.2% in June. Higher exports to Hong Kong, Netherlands, and China, along with the United Kingdom, helped increase our overall exports. Imports from countries aside from the United States fell by 5.3%. Most of the declines were from Asian countries due to the Delta variant being spread there and things being shut down. This helped shrink the Canadian trade deficit with countries other than the United States from a record of $7.5 billion in May down to $5.1 billion in June. You can see here, this is where we like to be. Nice positive trade surplus, big swing of almost, let's call it $5 billion from 1.6 to 3.2. A good swing there for the economy. Definitely help GDP numbers grow in the right direction. The question is, can we continue to see this surplus grow in the next month? Again, Canadian producers of energy producers are going to try and take advantage of higher prices and as demand increases. However, our inability to grow our export capacity in a meaningful way means we are going to be limited to being the fourth largest oil producer in the world, as the TMX Trans Mountain continues to be a work in progress. Line 5 and Line 3 continue to be under harassment. Keystone XL has been canceled. So a lot of wasted opportunity, squandered opportunity to grow our pipeline capacity, and that has kept us off the podium, so to speak, when it comes to producing oil. Exports moving in the right direction. We need to continue to see exports grow not only to the United States, but to the rest of the world. And imports shrank, not necessarily the worst thing. Obviously, consumer imports is something that drives growth because Canadians are spending money, but we want to see Canadians spend more money here at home, and we want to see exports grow to help boost the Canadian economy overall. Talking about labor, as public health restrictions are eased across the country, we see Alberta lifting all restrictions, Saskatchewan in July 11th, British Columbia has no restrictions of beginning the 1st as well. And this we saw helped increase employment by 94,000. Who knew? When you decrease the restrictions and increase people going back to work, more jobs are created. So we've added 231,000 in June, added another 94,000 in July, bringing our total employment to just shy of our pre-pandemic levels. Now, the gains in July were almost entirely created in Ontario. They were between ages 15 and youths ages 15 and 24 and core-aged women. So we are now approximately 250,000 jobs below the pandemic level of February 2020. The number of employed people who worked less than half their usual hours fell by 10% in July, while the total hours worked were 1.3% higher month over month. Now we are still 2.7% below pre-pandemic levels, but we are moving in the right direction. Employment gains were led in Ontario, Manitoba, Nova Scotia, and Prince Edward Island, and the only province to see employment drop was Saskatchewan. The second consecutive month, British Columbia is the only province where employment is actually above its pre-pandemic level. Now, employment gains were concentrated in the private sector, which grew by 123,000 or 1%, and again, mostly in the food and accommodation services. Self-employment was little changed in July, and compared to the pre-pandemic level, is down about 7%. And since the pandemic started, self-employment has seen basically no growth overall. The number of public workers actually fell by 31,000 for the first decline since April of 2020. Now, half of this employment decrease was attributed to Quebec, where there was a larger than normal summer decline in the number of educational services workers. Full-time work grew by 83,000, the first increase of March 2021. And the full-time workers were growing across the entire industries, across the entire economy, excuse me. Part-time employment held steady in July and has reached the same level as February 2020, so pre-pandemic levels, which is great, but full-time work still remains about 1.5% lower. Of those who worked part-time in July, approximately 26% would have preferred full-time work. Remember, the economy benefits the most from full-time private sector jobs as they are typically higher wage, higher value added, and add more economic gain. The unemployment rate fell by 0.3% down to 7.5%. This is considerably lower than the peak of 9.4% in January of 2021. So we're seeing some actual gains here, which is great. The total number of unemployed fell by 70,000, which includes an 11% drop in those who've been out of work for 27 weeks or more. So those people who've been unemployment for 27 weeks or more are we call the long-term unemployed. And while it remains approximately 245,000 higher than pre-pandemic levels, and accounts for more than 2/3 of the unemployed, it is starting to shrink, which is good. The labor underutilization rate has declined as well, down 1.2% to 14.4%. The labor force participation rate is just 0.3% lower than pre-pandemic levels, sitting at 65.2. So that is really strong. After falling in April and May, to see the labor force participation rates hold steady in June, it is strong. So unemployment rate is falling, labor force participation rate is staying steady, which means more people are entering the labor market. They feel less discouraged. They feel like the ability to get a job, and a good job, is high. So there's more jobs being created, more people entering the labor force, unemployment rate is falling. That is all strong signs for labor growth here in Canada. Again, we just see more full-time private sector jobs being created. And again, it's summertime. You'll see a lot of, server jobs at restaurants and those kind of jobs coming back for the summer and into early fall. But we're going to see those higher value added jobs being created to really help push economic gains. So labor force participation rate staying the same, which is good. As unemployment shrinks, as a good sign. So either you got the email from Jonathan or you read in the news about Enbridge, but good news. Profit in the second quarter beat expectations as oil volumes transported on its mainland system rose from the same time last year due to the rebound in demand. The performance reflects a steady recovery in Canada's oil and gas industry as rising oil prices encourage companies to restore production that was shut down at the onset of the pandemic. Enbridge transported 2.6 million barrels of oil per day on its mainland system, which is 7.5% higher year over year, but it moved less oil in quarter one than it did in quarter one when it moved 2.75 million barrels per day. Now, the company did previously warn that scheduled maintenance for oil sands upgraders and refineries will be more concentrated between April and June. So that's, of course, to see a little lower number is expected. But for the full year, Enbridge still anticipates hitting 2.8 million barrels of oil pumped per day, or moved per day. On the technology front, Enbridge is partnering with Savante Inc. and other firms to explore carbon capture opportunities. While they are looking to partner with other oil sands producers and heavy industries about a potential involvement, they are still looking for clarity from the federal government about tax credits it's developing for these kinds of projects. Full year earnings before interest, taxes, depreciation, and amortization, along with distributable cash flow, is expected to remain within the provided outlook, 13.9 billion to 14.3 billion. And for EBITDA and distributable cash flow is expected to be between $4.7 per share and $5 per share. The company reported adjusted earnings of 1.36 billion or 67 cents per share versus expectations of 57 cents per share. So I would also expect quarter three to be strong for the company as well. Demand continues to be high as energy prices remain high. So we'll see maybe closer to 2.75 million barrels per day of oil pumped. A lot of toll upgrades there, so we'll have to wait and see, but I would expect for Enbridge to outperform expectations once again. Employment situation report, major market movement report, strong impact on the market on Friday. Hiring was really good. Despite the Delta variant fears of COVID-19, hiring rose at its fastest pace in almost a year. Companies continue to struggle with a tight labor supply. Non-farm payrolls increased by 943,000 in July, which pushed the unemployment rate down to 5.4%. Analysts are expecting the labor market to only add 845,000. The Delta variant impact was unknown, but we'll take 943,000 over 845,000 any day of the week. Average hourly earnings rose more than expected, hitting 0.4% higher for the month. It is also now 4% higher year over year. This is a positive note for the economy that we're seeing earnings increase as well as inflation increase. And earnings are growing faster than inflation. The rising demand for labor associated with the recovery from the pandemic has put an upward pressure on wage growth. And even though wage gains are uneven throughout the economy, it still will allow consumers to handle inflationary pressures. Now, the decline in unemployment looks even better when you tie it with the rising labor force participation rate. It hit 61.7%, tying the highest level since the pandemic started. Discouraged workers and those holding part-time jobs for economic reasons fell even further, falling from 9.8% in June to 9.2% in July. Again, strong demand for labor, rising wages, rising hours, number of hours worked, number of people entering the labor force is going to create more positive momentum in the coming months. The jobs numbers have been strong on every level, and it signifies that there's more growth to come, especially as demand in the leisure and hospitality sector continue to be high. Wages in this sector rose 1.2% month over month and are up over 3% year over year. Education added over 261,000 new hires. Private payrolls are up over 700,000 in the month. So all these factors combining with the economy reopening, we're seeing more people going back to work, more money going into people's pockets, more spending being occurring. When people start to spend, that means consumer spending will increase both domestically and internationally, which means more Canadian goods will be bought. So that's going to help boost the Canadian economy as well. So that's why it's important to understand these major market moving reports and how they impact not only the domestic economy, but Canada's economy as well. If American consumers are buying, that means Canadian goods will be bought, more exports, more economic growth. So farm payrolls, we're strong, hitting almost 1 million 2 months in a row, which is what we want to see. And we need this trend to continue, quite frankly, to see sustained economic growth in the United States. Unemployment rate moving in the right direction, as it has been since the economy started to reopen, people started going back to work. All right, now we're going to start into the technical analysis portion. A little bit different than Jonathan's style, obviously, but we're looking at most of the same things. So let me know what you guys think throughout the week. So we're going to start looking at the TSX, and this is a 3-year weekly chart. The reason I really tossed this in here is because nothing to the left matters because of COVID. This has changed, our timelines of things. We went from about 11.5 in March of 2020, April 2020, all the way up to hitting 20,500, which is astounding. We've hit 9,000 point growth in about 18 months. Who would have thunk it? Remember when we all thought that everything was dire, doom and gloom? We're rebounded, got almost back to where we were, and we've taken off again, right? So things that have impacted the market, low interest rates, positive reaction to the vaccines and number of people getting vaccinated, economies reopening, savings being one of the big things is people have saved a lot more money this time around instead of spending it. So there's got a lot of spending pressure or spending capability in consumers' pockets, which should drive economic gains. So we're moving in the right direction. Market is hot, and I'm sure we could make 1% here or there moving through. 6-month daily chart, again, strong uptrend all the way through. Not as steep as the 3-year chart shows, but the MACD histogram are up. Things are growing here. Another new high was hit over the week. As you can see, the RSI is pinned to the top. So technically it should be a blue circle, but it's at at the very top end, so it has nowhere else to go. Momentum here, I put it as blue, but again is green because again pinned to the top, not much room for it to grow. So the overall market is heading higher. When we look at the overall market, this chart is a bit kind of difficult to read at points, but in between the blue Bollinger Bands, the TSX, so the open high low is the TSX. This orangey gold color is consumer staples, green is the financials, blue is consumer discretionary, purple is energy. So you can see that consumer staples outperform the market. Consumer staples is that not so sexy stocks, you know, they're boring, they don't move a ton, but they are moving forward in the right way. And that's what we need to see, right? So that's, you know, where we can make some money. Financials have rebounded strongly with low interest rates and continuing mortgages being taken out and other sort of loan products. Energy is starting to come around, which is good. You know, we need the energy sector to be strong, and consumer discretionary, again, quote unquote, not so sexy, but good options all around. So here we can see is a 6-month daily chart for gold. At 1763, gold is still high, not as high where it was, you know, a couple of weeks ago at 1900, but gold is also a currency, not a commodity. With the positive news about vaccines, with the economic reopenings and things like that, we are seeing, you know, people moving back from gold into the stock market. A lot of money in the sidelines. While the market is still high, money from the sidelines has been even higher. So people are starting to move back, but as inflation continues to rear its ugly head, we will see gold be an option as well, and it will start to rebound, you know, in a few months or even a few weeks as inflation continue to grow. Oil has done a remarkable run up. It went from 58 to 68 in March, April, May, June, July. 4 months, it's gone up $10. And this is West Texas Intermediate. Brent is about the same price. Western Canadian Select at worst trades at $10 below this, so it's at $58. Suncor IMO will take that all day long, right? They've really worked to reduce their costs, and you know, if the cost per barrel is $30 and they're making 58, I think revenues are going to be a lot higher than we expect. So speaking of energy sector, let's take a look at Enbridge 6-month daily chart. Nice trading range here between 48 and 50. MACD, the MACD histogram, we see a cross here, which is a good sign. Momentum is through the roof here, but we are really close to resistance. Okay, we did hit the 50.26 a couple weeks ago, but it came back down to 48. It's gonna go up to 49, maybe 50, and come back down. You know, there's not a lot of room to jump in at the moment here. Okay, so while we see green, green, and green, and that may say go, when we look at the range, we say, not enough room to make 1%, not enough room to make any, you know, any real significant, you know, money here. We got like 37 cents. Let's just wait. The 10-day, 30-minute chart shows that peaked at 49.80 on Friday, came back down and rallied a bit, but even though momentum is here, just be patient. Wait till it comes back down. If you want to run a 49 to 50 or even 49 to 49.75, you know, you're more than welcome to do that, but I'd be more interested here at 48. Or if you're looking for a more buy and hold opportunity, then you can just buy and plug away. Just set it and forget it, because guarantee you Q3 is going to be very, very strong for the company. CNQ, one of the, I think it's the second largest, if not first, but second largest oil producer here in Canada. In the middle of the channel, which is good, we see a MACD crossover on the 6-month daily chart. RSI and Stochastic are both saying go, go, go. So there's room for it to go. If you go from 42 to 44, that's $2. Take that any day of the week. $2 on a $40 stock, not a bad return. So may take some time, but again, it came from 44, hit 38, back to 41. Now, if it drops back down to 40 or even 38, by all means, jump in if things being careful, but looking at the indicators here, middle of the channel, lots of room for its next resistance level would be something to be interested in. The 10-day 30 shows that it hasn't broken 42 for all of Friday. Did work its way up throughout the week from 40.31 up to 40.85, so about $1 there, $1.50 throughout the week there. But again, a consistent 40 to 41 over the last 2 weeks. So that could be the range for now. Momentum is pulling away as it tried to break through 41.85 for 40, let's call it 42 on Friday, but couldn't. So if it manages to break through on Monday, 42 to 44, but if not, let it come down to 40 and run that 40 to 41 or even 40 to 42 and make a couple bucks that way. IMO, again, similar to CNQ, we see a cross previously end of July. MACD and MACD histogram is growing. The divergence is growing, which is a good sign. Momentum is fully in the stock here. Again, in the middle of the channel. It's quite a wide range here from 30 to 40, but around 34, 35, if you want to jump in on the upswing, which is great, but let it cross up first. Once we see some positive momentum, 35 to 40, again, a little bit of a hold here. But even if you hit 35, hit 37.50, you know, make a couple bucks that way would be great. But be prepared to hold for a little bit. As you can see, it takes usually a couple weeks of it sitting around. Couple weeks, come back down, couple weeks. So it could take its time to get up, but it could be a nice investment here as, again, middle of the channel of its overall range. But wait and see if it breaks through 35 or not. On the 10-day 30, again, similar kind of message here. MACD and the MACD histogram are flat. Stochastic and RSI. Stochastic is showing a bit more room, but RSI is pretty flat. We have to wait and see. Let it break through 35 before we get really interested, or let it come back down and let's earn $1. If you went from 33 to 34, earn $1 on a $30 stock, I think you're doing pretty good there. Suncor, we just saw a cross in the last week, so that's a good sign. Momentum is clearly with the stock. We are in, if we're to divide this channel into quarters, so, you know, 25, sorry, the bottom line is 25, 50, 75, 100. We're kind of in that middle channel, middle of the first channel here, okay? So there's still room for it to grow. If you got from 25, ran to 26, that's $1, great. And that's definitely doable, especially if energy prices continue to skyrocket, or at least hold this high. Again, I would imagine at the beginning of the cross here is definitely a clear buy signal. And I'm really intrigued at it being in the middle of the first channel. If we can get it at 25 and run it up to 27, would be very interesting. But let's see what happens on Monday and where it goes on. If it comes back down to 23 or even 24, again, another alert for your put on potential buy alert. Let's see where it went. It hasn't dropped below 24 since February, and the metrics for oil and the value for oil is much stronger now than it was in February. So I expect it to continue to move up. Will it break through 25, 26? Unsure. If it breaks through 26, then we have more room to play. 26 to 28, $2 on a $25 stock. Pretty good. 10-day, 30-minute chart. MACD and MACD histogram aren't too happy. Momentum has started to turn. We do see a potential cross here on the stochastic. And that's just basically due to the 24 to 25 mark. Even if you ran at $1, you know, not bad at all, right? But just be aware. Let's see if it breaks through 25 or not. If it doesn't, let's see if it comes back down. If you can get it under 24, that would be an ideal position if it turns down. Now, we talk a lot about Enbridge as a pipeline utility, but we can't forget TRP. Enbridge does provide a better dividend, I believe, on a per cost basis, but opportunities abound where opportunities abound. TransCanada, priced a little higher for sure. Middle of the channel almost, not a lot of room here before it hits 62. If it breaks through 62, could it go up to 64? For sure. I'd be happier to get in around the $60 mark, 60, even $60.50. But again, positive MACD and MACD histogram. Momentum is clearly with the stock. So potential, again, another one you may want to put your alerts on. The 10-day chart, again, showing not a lot of room. While the MACD is positive, the divergence is slowly shrinking. So even though momentum is here, not a lot of room between 61.28 and 64.50 before it turns back down, right? So instead of making it 30 cents, let's see what happens if it breaks through 61.50. We can get to 62, even 62.50, but I'd be, again, happier to get it closer to the $60 mark to really maximize your returns. Here is the Canadian dollar, what it's performed in the last 6 months. The Canadian dollar, as it becomes more expensive versus the US dollar, will make Canadian imports more expensive. So while we want a strong dollar to help buy goods, we also want to walk a fine line of, can we get this number a little lower to entice more people to buy Canadian goods, right? So it'll be interesting to see what the Bank of Canada does. Moving forward, so that'll be interesting. And relative to the US dollar, this is how the Canadian dollar has done over the last 5 days. What's interesting to me is the 52-week range, 74.5 up to 83.3. We want to continue to see this number come down, and we are trending down. So as things start to reopen, currency investors will look to trade with the United States, US dollar, maybe in the euro, and this will help depreciate the dollar a little bit, enough to entice more Canadian exports. On the financial side of things, looking at BMO, again, a bit of a higher price stock at about $1.26, but again, middle of the channel, MACD crossover, momentum is here, which is good. You know, if you run 126 to 130, it might take a little bit longer. Even if you ran 126 up to 129, you know, $2.50, $3 isn't so bad, but it may take some time. But again, something you may want to look into for the financials. On the 10-day chart, tough time breaking through this 127. It tried all week, couldn't, came back down. I would expect this to maybe hopefully retrench a little bit as we see, a cross down, momentum falling away. I mean, I could have made this red, but I was a little generous. So if it comes down to 124 to 127, $3 isn't so bad. Could be something to look at as well moving forward. Bank of Nova Scotia, kind of the same boat here, just at 79.60 up to 80. You know, not a ton of room here. Did crossover. We are seeing momentum with the stock, but I'm a little concerned about how much room it has here to move to gain us some actual profit. The 10-day chart couldn't break through 79.60. Peaked out earlier in Friday. Momentum's coming to come down. Again, once this trenches back down to 77.50 or even 76, I'd be way more interested. But again, something you may want to think about. CIBC, great. Not enough room. Okay, it's hitting its high here. Hasn't broken through 147.50. Let's leave it alone. Wait till it comes back down. I'm way more interested at 140. It has run this nice range since the end of May, 140 to 147, back down to 140, 143, back down to 140, back to 1.47. So you know, if you can get in at 140, it's going to run a few bucks. Let me put a potential trailing stop at 143 and see where it goes after that. If you can run from 140 to 147, $7, pretty good range. The 10-day chart, again, shows some really strong growth appreciation from 144 to 147, so $3 there. But again, reached a high on Friday, couldn't break through. I would expect this to pull back down. And again, wait till it's back to 143 before we even get interested and really start to put your buy orders in at 140. Royal Bank, same thing. Great appreciation. Momentum is definitely with the stock. MACD histogram is turning higher after 1, 2, 3, 4 days of a higher growth. But is there enough room for us to make a good profit? We can probably make a few cents, but is it worth our time? And my answer right now is no. 124 to 127, 128, all day, every day. We'll take that. Again, end of May until now, 124.50 we'll call it, up to 128.50, $4 right there, right? We can run that every couple of weeks, not a problem. The 10-day chart shows that it topped out at 129.68, couldn't break through, is coming back down. Let it come back down, be patient with this one, but it's good to know where to put our alerts to jump back in later. TD, exact same thing. Way more interested here at 81.50 than I am at 84.50. $3 range, no, not problem. It did run a little higher earlier in the quarter, but you can see here more memories in this 81 to 84 range. Continues to be that way. So even though we have a crossover, not enough room here. Let's look, even though momentum is here with the stock. The 10-day confirms it, continues to see, we couldn't break this 84.75 mark. So let it pull back down, come back down, and that's probably going to coincide with a bit of a pullback in the market, which is totally fine, totally acceptable. But we now know some good entry points for these major banking stocks. Now we're going to head over to our good friends in consumer staples, QSR, restaurant brands. We've seen quite a few gap ups and gap downs over the last few weeks. Again, nice big range from 77 to 84. Nice range there. Even though MACD and MACD histogram are positive, the divergence is shrinking and it's heading down. So not a good sign. Momentum is pulling away, and this one is red. So would I be interested at 79 and 80? Possibly, but I'm hoping to get closer into 77, 77.50. Once it gets closer down to here and starts to turn up, great. If I can get in at 78, run it up to 82.5, I'm game, right? But 78 up to 80, 81 seems to be a little more of a practical target. You can see that it does have, a $4 or $5 range all the way through. You just have to really pay attention to the ranges here because it is very cyclical. This is something you may want to look at and put a buy alert in on those when it comes back down. 10-day, 30-minute chart, again, confirms what we know. Couldn't break through 85, had to come back down. Momentum is clearly pulling the stock away. But again, if I can get in at 77 and 78, I'm a little more interested. Canadian Tire, again, a lot of weird numbers here. It doesn't really move a ton throughout the day, but that could be due to its earnings report coming out soon. I believe it's next week. We'll find out at the end of this who's all reporting, but I believe Canadian Tire is reporting. Strong run up throughout the early part of end of Q1, beginning of Q2. Still a relatively high price stock, but if I can get it back at 240, I'm way more interested. Even at 250, I'm more interested. $10 on this $250 stock is a good return, but right now, stay away. This chart looks really weird. I know when I rendered it the first time, I thought I did it wrong, but the 10-day, 30-minute chart, you can see not a lot of movement, and I would attribute that to the upcoming earnings release. And I expect the earnings release to be good for Canadian Tire, so we should see some movement for the stock. DOL, Dollarama, a place we go to often, but not think about. So let's take a look at the charts here. Similar to many others, not a lot of room here. We're hitting at resistance. Something obviously we don't want to jump into. Hit a high here on Friday and it's starting to come back down. But MACD and MACD histogram is starting to diverge. The divergence is growing, but I'm still concerned about the lack of room for us to make some profit. I don't want to be the one buying at the new high, and I don't want to be the one holding the bag when things start to come back down. So if it comes back down to 56, 55, even 56.50, I'm interested. 56.50 up to 858, $1.50, not so bad. Gives you something different to do. Comes back down to 52, as it did in the beginning of June. Way more interested for sure. 10-day, 30-minute chart. We saw we hit the high of $60.03. I believe that's a 52-week high. Couldn't keep its momentum, pulled back down as there was definitely some profit taking there for sure. Momentum is clearly away from the stock, but again, something you may want to put a pin in and watch moving forward. Consumer discretionary. So we had Dollarama and Staples here. Now we look at Alimentation Couche-Tard. If you're not familiar with Alimentation Couche-Tard, they are a convenience store brand. They own a bunch. They own Circle K, not only in brands across North America, but brands across the world, in Asia and in Europe. A lot of fuel stuff. So they're a very interesting company here. However, coming off a 52-week high, not so happy at 52.04. If I can get it back down here at 45 to 49, totally in for that. But we're gonna wait until the stock retrenches. As I'm expecting it to come back down, here's that $50 mark. Once it breaks below 50, hopefully it comes back all the way down to 45 to give us some room to grow. But it did cross down on the MACD and the MACD histogram, so a clear sell signal. And momentum is away from the stock, so stay away. But again, something to put a alert into for future reference. We did see a cross up here on the 10-day, 30-minute chart, but momentum is clearly in the blue. Now, just a quick reminder, when you're looking at indicators, on the longer term charts, like the 3-year weekly, MACD, the MACD histogram have more influence. On the shorter term charts, the stochastic and RSI have more influence, okay? And that's because they are leading indicators versus lagging indicators. But when you're making your decisions about look at this, even though the MACD histogram and the convergent divergence is growing, the momentum indicators here have more influence and more weight in my decision making on the shorter term chart. So the fact that momentum is pulling away and that there's no room for growth means stay away. Metro, nice little run up here for sure. I believe they report as well this upcoming week. Hit a 52-week high earlier in the month, and then boom, 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 pulled away. Not good. MACD's coming down, going to definitely cross under. If it crosses under, it's most likely going to break through our trend line here. And again, I'd be way more interested at 62 bucks. Be even better at 60 before when made this run up, but we'll have to see. I'm sure it's going to have some strong numbers to report. So we could see it pop up even further. But again, something I'm not necessarily going to jump into just because the trend is so high. Because let's just say, for example, if we go from 64.50 up to 65.50, that's just $1. But who knows how much this is going to move. I'd rather it come back down to 58 to 60, work the $2 all the way through. 10-day, 30-minute chart shows that on August 3rd, hit its 52-week high, trended lower ever since. But again, I believe that's due to report season coming this week, even though these are all green. Let's wait and see. Saputo, I expected a bit more from the stock, but it's been trending recently between 35.50 and 38. So there is some trending money there. In the middle of the channel here, I haven't seen this break above the 36.56 mark since middle of June. I expect this to come back down. Again, another easy one to make $1. So that's definitely a good sign. But if you're looking for a couple bucks, this may not be the one for you. But making $1 on a $35 stock, we'll take that. 10-day, 30 minutes. Again, confirms couldn't break through here. It's going to come back down. Not looking good overall. Let's get more interested at 35 and just wait for this one to come back. CNR, nice little uptrend here as well, but not looking good on the 6-month daily. Closed lower than it opened last week, so not good. Flat, 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 staying away. Let's just come back down to 129. At 129, I'm a happy camper. 129 up to 135, we can do that. Even 129 up to 134, 132. Who cares? $3, $4, hit it, quit it, get out of there. Make your profit and go. 10-day, 30-minute chart shows the same thing. Couldn't hit the 138 mark. Came back down, crossed down, not a good sign. This one is showing definite momentum pulling away. Let's just see this pull back, retrench a little bit, and then we can jump in once more. CP, again, in the middle of its channel, getting at 92, running up to 94, $2 wouldn't be so bad. I'd rather get it in 89, run up to 95, but It takes a little bit more patience. You gotta have to wait for the stock to come back down. Some positive momentum in the MACD, the MACD histogram. Momentum though isn't quite sold on the stock. As you can see, it's very hard to see, but it closed lower than it opened on Friday. The 10-day shows it tried to break through 93.3, couldn't do it, came back down. You know, if it breaks to 94, great, but again, more interested back at 90, even at 89. I'd love to make $5-6 on this, so be a little patient, wait for it to be retrenched. Momentum is coming back to the stock here. We have a possible crossover. So, you know, 92 to 94, if you're okay with that, great, but might be a little more difficult. Might be looking at a 92 up to 93.5. Last but not least, West Fraser. This one surprised me the most. I really thought there'd be a strong correlation between building permits and the stock. However, when thinking about it, companies have already bought softwood lumber to meet some of their demand. So we'll have to wait till they get through their inventories and start buying it up again. But demand for softwood lumber, both in Canada and the United States, remains strong. I'd be more interested again in West Fraser, back at around 85 to 92. Let's run that instead. Let's be patient. You can see a lot of history there at the $85 mark. Again, it did jump really high, you know, as builders prep for the busy summer season. But if we can hit 85 up to 92, $7, we can take that all day long. 10-day chart, same thing, kind of shows us here. July 23rd hit a high of 92. That's come back down to 86. So 86, even we went from 87 to 91. $4, not so bad return. I would think I'd be happy with that in my bank account. So just to give you guys some ideas, what you should be looking at, what you could be looking at, how you could look at it. Not everything is going to be a winner right now, but it should give you an idea of, hey, this could be something in the future. I want to put my alerts in, so when the stock does come down to a potential buy area, I'm not caught unawares. So Monday we have NTR Nutrien reporting. Wednesday FNV and Metro reporting as well. Thursday we have CTC, Sierra Wireless, and Wheaton Precious Metals. So be aware of that as you're moving forward. Something to be aware of. And I would expect to see some movement on MRU and CTC at the end of the week, because they're going to have some positive growth. That's it for us today. Jonathan should be back next week, and if he's not, round 2 of me. So let me know any concerns, questions, comments. Other than that, we'll talk to you soon. Bye now.